Alrighty guys, thanks for clicking on this week's video. Today we're going to go over the bull call options trading strategy. So just like all the other videos with the trading strategies, I'm going to show you how to do this, and then the next part of the video I'm going to explain why we did this a certain way, the pros, the cons, how to find the max profit, max loss, break even point, etc, etc. So the first thing you want to do is you're going to want to buy a call in the money already. So for example, you could choose where you want to go. As you can tell from my more previous videos, I'm more of a conservative investor, or at least more on the conservative side. So I always try to go as close to the share price as possible. So we're going to buy this one at 290, and then simultaneously we're also going to sell another call, but this call is actually going to be out of the money. So we'll sell a 46 strike price call and buying a 45 strike price. This is going to cost us about $40. So we're going to go over the max profit, max loss later, but thanks for watching, and I'll see you in the next part of the video. Alright, welcome to the second part of this video of the bull call option trading strategy. So the first things first, we want to find out what our max profit is. So to do that, you take the spread, you subtract it from your net debit and multiply that by 100, which in our case, our spread is going to be $46 minus $45, which is a $1 spread, minus our net debit, which is 0.4, which gives us 0.6 times 100. So our max profit is going to be $60. Next, we want to find our max loss. It's basically your net debit, which is $40. So you're going to have a max profit of $60 and a max loss of $40. I know it's not very exciting numbers. Obviously, like I said, you can change these up to any way you want. Just the main idea is you need to buy a in the money call and sell a call simultaneously that is either at the money or out of the money. Just make sure it's further away than the call that you bought. So the next thing that we're going to want to find is actually our break even point. And the way you do that, you take the option that you bought, which in our case was $45, and you're going to add it to the net debit, which is 0.4, which gives you $45.40, and that is your break-even point. So now some of the pros and cons of this. Pros is that, as you can see, this does not require a lot of money whatsoever. It costs, in this case, it's different for every stock, but in this case, it's basically only going to cost you about 40 bucks, and you can make $60, which if you think about it, your return on investment is huge. It's like 1.5. Now some key takeaways before we get into more of the pros and cons is when doing this, again, you're going to want to do this about 3 weeks out, and you want it to a stock that's going to be going up, obviously. So again, do your due diligence to make sure that you're still picking a stock that you're comfortable with, especially because in this case, time is not on your side. So I'll just be very wary of that as well. But either way, I hope you guys enjoyed the video and was able to add another tool into your options trading strategy, or just your stocks investing trading strategy lifestyle as well. As always, I love making these videos. I hope you guys enjoyed it. Remember to leave a like, comment, and subscribe for more future content.